Hello, my name is Doug Huber, and I'm the Deputy Chief Investment Officer here at Wealth Enhancement. Welcome back to our new series we're calling the 7 Weekly Market Movers. I'm going to give you some updates and talking points about the market and some recent developments related to the economic growth expectations, some new news around U.S. monetary policy and the interest rate outlook, talk a little bit about investor and consumer sentiment, and then cap it off, really tying it all together and kind of what are the risks that are influencing the global economy as of the week of March 24th. The noise that's dominated the market movements over the past few weeks has not quieted down this week as more conjecture, posturing, reversals on ongoing tariff fights continue to have market participants just trying to figure out which way is up. And while these periods of volatility are certainly uncomfortable, it's important that we take a step back to view the proverbial kind of forest through the trees. Fortunately, we started the year on stable economic footing. In Q4, the economy grew at an annualized rate of 2.4%. And for the year of 2024, the economy grew by 2.8%. So it was a really healthy kind of economy coming into the year. And I think expectations at the start of the year was that's what we'd have in 2025. However, this escalating U.S. tariff tensions and this uncertainty around where we're going have really introduced these risks to kind of our future economic expansion. And so today we're seeing that projections for 2025 U.S. GDP growth have declined from really 2.5% or more down to 1.5% to 2% for the year. And listen, there's an argument that maybe that's too high. And so what are we doing? What are we looking at to say, you know, is that the right number? Should we be looking, could it be worse? Could it be better? One of the things that's really been a driver of the economy over the last several years is the U.S. consumer. Really, the backbone of the economy has been the resilience of the consumer. And as such, we're paying really close attention to what are their future expectations for spending, and then the complexities that make up that cohort. First, if you look under the hood, over 50% of spending is attributable to the top 10% of earners. And while so far that faction has remained quite strong as their savings are elevated, they tend to be more asset heavy, so their housing prices are up, their stocks and bonds have gone up, that consumer is strong. The other 90% are faring less well. And while that's not necessarily a new dynamic, it is certainly shifting heavier to that top 10% over time. I think now more so than in the past, given that that 10% has really been the engine of the economy, those future spending trends are really what's going to matter from here. And so what are we going to look at? What can we look at? What can we pull on to say, is there a slowdown there? And so listen, sentiment can be fast moving and certainly can change with headlines. But the recent sharp decline in consumer and business sentiment, frankly, can in and of itself kind of effectuate this virtuous cycle. If your outlook for the future wasn't as rosy as it was 2 weeks ago, and today is going to be the day you're going to start tightening the belts, right, for the future. And so we're looking to see, are there signs of cracks, especially in discretionary categories? So we looked at the most recent CPI print, and you will see that a lot of the underlying items in that discretionary area, like airline travel, rental cars, hotels, appliances, furniture, things that aren't needs, more wants, we have seen slowing there. And while that's just one data point, it'll be really important to watch how both businesses and consumers spend from here. I think while there's no signs of immediate distress in the economy, and we're certainly not signaling that, we definitely think there's a lot of definitive agreement around this idea of slowing growth and the potential for a recession. These thoughts could lead to lowered sales and earnings projections across sectors. So we're really keeping an eye on how that consumer is doing. Kind of tied to that, or very much tied to that, is we're also keeping a close eye on the labor markets. Well, we haven't seen a substantive increase in unemployment. There are some data points we're monitoring. First, we have seen job openings continue to decline, and that can definitely be a precursor to a softer labor market. Just think about it. If I'm a business, I'm putting all these job openings out there because I'm growing or I'm anticipating I'm growing and need to hire in for that. Well, the first thing I'm going to do if I see signs of contraction is I'm going to take those jobs off the market. And then my next step is to start the layoffs. And so a lot of people look towards this job openings as a potential kind of preview of what we might see in other areas. So we're paying particularly close attention to that. Another area we're looking at is obviously we know that there is going to be some headcount reduction on the government side, and the government's been a big employer. But 25% of jobs created in the last 2 years were from the government, and so we know there's going to be some unemployment coming from that sector. I still think there's uncertainty around how big that number is going to be, And there's also kind of a follow on, a knock on that we know there's private sectors that are very correlated to the government. There's a lot of contract work that gets done. And when a government employee gets laid off, typically there's some cohort on the private side that will also get laid off. So paying really close attention to the labor markets. The other thing is, listen, markets move around the Fed. We all have heard about the Fed. We know about the Fed. The Fed, it's a drug we're all addicted to, that the Fed is really, what the market's paying attention to. And last week we did see a Federal Open Market Committee, or an FOMC meeting. And this is where the federal governors get together to discuss current economic and financial conditions, and they set monetary policy. And so we haven't had any change in interest rates, right? That is something they have not started to cut rates yet this year, although the prediction is that we will have more rate cuts than was anticipated to start the year. They have changed their outlook a little bit. The tune in what they are saying has become a little bit more risk aware, let's call it that. They have made specific references to really paying attention to elevated risks as it relates to what they call their dual mandate, and it's this idea of full employment and stable prices, or inflation. And so it's interesting, that they are clearly posturing around, they're seeing risk in the markets. The other thing I think that's interesting, it didn't get a ton of airtime, is that while they didn't cut rates, they did signal that they're trying to ease the supply of U.S. Treasuries in the market by kind of not letting as much of their supply roll off. And while that's a bit of a complex thing we don't need to go down the path of, the idea of it essentially is that is a move away from a more tight economic posture to one of more of an easing posture. And so while they haven't cut rates, they are saying, listen, we're going to start to soften a little bit over here. And so it'll be interesting to see, how the market reacts to that, and if that is a precursor for them, to start, moving towards a more easing posture in the coming months. From a performance perspective, listen, this week has been a bouncy one. The S&P has been up, down, up, down. And so as the close on Thursday, the 27th, the S&P was relatively flat for the week. Similarly, bonds have been relatively flat this week as rates have oscillated kind of on a lack of clarity of monetary and fiscal policy. That said, this year's been unique to the most recent past, as finally, or for the first time in a little while, a diversified portfolio has done well. Bonds have behaved like bonds, right? We had a nice, healthy income from bonds today. They're doing their job. They're kind of offsetting equity risk, which is why we hold bonds in portfolios. So that's been a positive. Within equities, we've seen increased dispersion of returns as more defensive sectors have kind of rallied in the most recent days. And so that's interesting, right? Over the last several years, that the S&P 500 we know has been driven by the handful of the largest stocks. So this idea that these diversified and balanced portfolios are really doing well this year, and so that's a positive. At the end of the day, in the global economy is kind of navigating this complex mix of growth challenges, policy uncertainties, inflationary pressures, etc. And I don't think we're signaling by any stretch that we think there's Armageddon on the horizon, but I do think we're being particularly aware of the data points that are coming at us. And so the one thing we do know for sure is that uncertainty is here to stay. There's going to be volatility around that. But what is exciting is that coming up this week, we have a lot of new data points, and ones that we'll talk about in next week's market update. So while I hope you found this useful, please tune in again next week. We'll have updates on what reciprocal tariffs may or may not have gone into effect on the 2nd. We also will see data on personal income and spending figures, going back to what I talked about with the consumer. We'll hit some numbers around consumer sentiment. And probably the most important is we have the release of the Personal Consumer Expenditures Index, or PCE index. And that's the one that tracks the values of goods and services purchased by U.S. residents. This has been a favorite measure of the Fed, and one they pay particularly close attention to as they kind of are in this balance with this fickle dance they're doing with inflation. So thank you for tuning in today. If you have any questions, please reach out to your financial advisor or investment management. Please tune in next week, and thank you again.